This is a podcast from the Business Times.
The Nasdaq and the S&P 500 fell into the red overnight, pulled down by another difficult session for chip stocks. Geopolitical tensions remain front and center this week, with the escalating US-Iran conflict pushing oil prices to their highest level in a month. Meanwhile, in Asia, it has been another roller coaster week for stock markets, as the AI-driven investment thesis is being tested once again. So is the tech pullback set to continue? Let's bring in our expert for more. Welcome back to Market Focus Weekly. I'm Clarissa Montero, standing in for the vacationing Howie Lim. It's Friday, July 17th, 2026. I'm joined by Vikas Pershad, Portfolio Manager for Asian Equities at M&G Investments. Now, we can't talk about markets without touching on the latest geopolitical headlines. But Vikas, how's your week been?
It's been good, actually, Clarissa. Thank you for asking it. Yes, Asian stocks have been on a roller coaster, but that also creates opportunities for long-term investors. The issue that we have had over the last couple of years, since the Trump tariffs were announced last year, is velocity. So volatility is our friend, shakes markets up, shakes things up, dislocates things, allows us to get in at better levels. But we have to be ready. If you just look at how these AI stocks have traded, look at how the defense and energy stocks traded in March and April, when the latest conflict started. If you do your homework, you bet right and you sit tight, there's a lot of opportunities to talk about in Asia.
There's a lot of opportunities. Okay, let's talk about some of that volatility, geopolitical volatility. The escalation between the US and Iran has renewed concerns about higher inflation, particularly here in Asia, which, we are highly exposed to imported energy. How do you see these inflationary pressures affecting Asian companies, and where are you finding investment opportunities in this environment? You obviously are.
Yes, a lot of opportunities are coming out of the most recent conflict. If we just start with energy and we start with the basics, oil first, our view is that Asia can survive expensive oil. What it cannot survive is surprising oil. And it's the surprise, not the price, that shows up in earnings. So what does that mean? It's the volatility that we're seeing. It's hard to plan, to budget for expansion, for airplane routes, for manufacturing, if the underlying commodity is as volatile as it is. And as you rightly mentioned, Asia is the largest oil importing region in the world. And so if you combine that with weakening currencies and a rising oil price, that's leading to some dislocations. So the pain is concentrated where you'd expect energy-intensive manufacturing, in chemicals, in transport, regulated utilities. But on the other side of that, there's opportunity. Businesses with genuine pricing power, domestic demand-driven names insulated from the import bill. You find a lot of those in India, from financials to consumption names to defense names, healthcare services. So in a shock like this, the winners aren't the companies that use less oil. They're the ones that can charge more for whatever they make. And there are good businesses with pricing power all across the region.
I want to go on to the AI boom that is pushing power demand from another perspective with energy to new highs. As governments and companies double down on clean energy investments, do you think investors should be looking for opportunities in this energy transition?
Yes, let's take a step back for a moment. If you look at why the AI tech hardware names have gone up so much, memory in particular, is because for conventional memory, for NAND, for HBM, yes, the demand has been strong, but we've seen a limited supply, especially in conventional memory and in NAND for many years. CapEx just didn't go into those spaces. If you look around the world, where else over the last 10, 15, 20 years have areas been starved of CapEx, where you're now seeing where that lack of supply growth is meeting a demand surge? So power is one of them, power transmission and distribution. And if you look at the companies that build the transformers, that build the power lines, that build the power antennas, they're scattered all across Asia. And yes, many of them have rallied over the last couple of years, but that's for good reason. If you look at their order books, if you look at the surging power demand over the next few years, that will continue. Even if there is a slowdown in the AI tech hardware trade, in the data center trade. I'll mention another point. There's a warming planet that we're dealing with. Our team has spent a lot of time thinking about the heat wave economy. And what does that mean? They're the obvious winners, air conditioner makers, but then the power surge associated with that is also something to take into consideration. So when you have a warming planet and you have data centers being built everywhere, more compute is needed, more air conditioners are needed, cooling is needed, both for the data centers and for air conditioners and homes and enterprises. This story is not going away for a very long time.
Okay, I get you. And you've got me interested as well. We are heading into earnings season. What are the key indicators you are watching? And are there particular sectors where you think market expectations are either too optimistic or maybe too pessimistic?
Yeah, so the first question is what we'll be watching. We now have a full quarter of companies dealing with the West Asia conflict. The March quarter, we only had 1 month of it. Now we've had another 3 months. So we'll see how these companies have dealt with the situation. I'll be watching margins over headline revenue and guidance relative to expectations. In an energy shock, in a dollar strong environment like we have, the gross margin acts almost like a lie detector for anyone who actually has pricing power. So we'll find out who actually has pricing power, who does not, who can manage the costs and the volatility of those costs, and who we cannot. There's been some margin stability, I would say more stability than I had anticipated for the March quarter. We're expecting more volatility in the June quarter. Now, we've had some companies report already, slightly disappointing for some names, slightly better than expected for others, but the expectations were very low. We're going to get into the heart of earnings season in North Asia and South Asia very soon. But I would say, coming back to the point, revenues can be managed. Companies can blame deferred demand or forward pull-in for revenue misses, but gross margins and operating margins is what we should be looking at.
What about equity capital markets? Well, if you look at Malaysia, they're leading among Southeast Asia peers. And, for long-term investors, and a lot of Singaporeans are, how do you approach this new issuance pipeline, IPOs?
There are a few questions here. So number one, I like what the regional data are telling me. Southeast Asia did fewer deals in the first half, but the proceeds were double of what they were last year, with the average deal size being bigger by definition. And as the market shifted toward bigger, higher quality listings, I think the opportunities also improved, and we should see that continue. But when I look at across the region, the opportunities that are coming to market, they are in areas that we know, so that's helpful. But in areas that are future forward, healthcare services, AI, tech hardware, these are not the companies of the past 10, 15, 20 years. And so as the benchmarks change and the IPO pipelines evolve, then it makes our job more interesting and more fun because we're investing for the future, not for where these countries have been.
Still to come, more on software fears, the memory sector, and India markets and its relative underperformance.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region. With analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
Welcome back. It's Market Focus Weekly. We're speaking to Vikas Pershad, Portfolio Manager for Asian Equities at M&G Investments. Vikas, turning our attention back to the AI technology theme. We've been talking about it quite a bit already. IBM recently suggested that AI spending is shifting away from software towards hardware, weighing on software stocks. Do you think the market has overreacted to this shift, or does it reflect a more structural change in how AI investment is evolving?
It's a little bit of both. And if you look at software first, our view is that software is not dying, but as with everything, we have to be stock specific, bottom up. And so when it comes to software, yes, many of the businesses that we are accustomed to investing in or thinking about, they will be weakened, materially so, over the next 5, 10, 15 years. However, there'll be many other companies that do even better because software is not dying. It's just that it can't be downloaded over a server. So hardware jumped the queue, and hardware won first, attracted a lot of investments. But if you look at software companies, the answer to your question is yes. That first sell-off back in early February, when the SaaS apocalypse kicked off and all these software companies sold off, I think that kicked off an overreaction. We, in February, March, April, selectively added more capital to these software names across the region and around the world as a firm. And so far, on balance, all of those companies have done better than the market since then. So I don't think the software is dying. But on the hardware side, a lot of money has gone into data center buildouts and networking buildouts in a very short period. The economics of that is still questionable. The spending could continue because of this arms race driven by 5 companies in the US, but it's not just those 5 companies. It wouldn't take much of a slowdown for the stocks on the hardware side to sell off. And that's actually what we're seeing. And so as the market got narrower and narrower, we got more excited because there's so many opportunities elsewhere across all sectors in Asia.
Okay, let's skip over to memory chip stocks. There has been significant volatility over the recent weeks. So do you see this as a signal that valuations have become stretched, or is this creating attractive buying opportunity for longer term investors?
We positioned ourselves for a strength in the memory sector about 2 years ago. We added to that amidst the Trump tariff volatility. Over the past 1 to 2 months, we significantly reduced our holdings in memory in particular. The reason for that, and to answer your question, is that it's not so much that the valuations became stretched or unreasonable. Assuming the earnings came through on much higher earnings expectations that people had, the valuations actually were reasonable. If you assumed that the pricing of memory for both conventional memory and for HBM on the DRAM side, and then also for NAND, if you assumed that the pace of growth in pricing would continue into the second half of this year, would continue in 2027, then the valuations were reasonable because the earnings were reasonable. Our view was that the earnings outlook for 2027 and certainly for 28 had become far too sanguine, and we started reducing our memory holdings. Layer on top of that, the big Chinese IPO coming in the form of CXMT. And what we've seen in every industry for the past quarter century, whether it was shipbuilding, renewables, autos, now semis, is that in many ways, these sectors are seen as sectors of national importance for the Chinese. Their cost of capital is lower, the time horizons are longer, and if these industries have mattered to them, then they will disrupt the economics for everybody outside of China. And that's what we presumed as a base case. And I don't think that that has changed enough yet, despite the share prices having fallen 40 to 50% for memory companies across the region. We are underweight. Of course, we reevaluate everything, but I think it's time to look elsewhere when it comes to opportunities either related to AI. We've been investing in not just the picks and shovels of the AI trade, but the picks and shovels of the picks and shovels, and we think there are plenty of opportunities there. But if you look across Asia, let's just say India as an example, 7,000 listed companies in India, several thousand in Japan, several thousand in Taiwan and South Korea and China as well. There's a lot more to look at when you think about where Asia will be on a 10 to 20-year horizon and beyond than just computing hardware.
Okay, how about semiconductors in Southeast Asia?
That's a great place to start. We touched on it earlier. If you look at the current compute architecture for the world, silicon-based computing, our view is that over the next couple of decades, perhaps sooner, you will see a significant shift in that to more photonics-based computing. And if you look at Thailand in particular, there are companies that are large and liquid and led by sensible management teams that will benefit from that. If you look at semiconductor manufacturing, it's very interesting to see how Vietnam is coming up the curve on that. India also is coming up the curve on that. I've been in India this week, toured a series of factories. It's very encouraging to see high-end level manufacturing, very advanced, expensive equipment utilized at 70, 80, 90% utilization rates, and with very few people making parts that will go into the semiconductor supply chain. Now, India is not yet making the etching equipment or the deposition equipment, but they're part of the supply chain now. And when you trace the supply chain all across Asia, there's plenty of companies that will benefit from rising capex. On this point of rising capex, the SPE companies, the semiconductor production equipment companies, have a pretty good few years coming ahead of them. Now, valuations are something that we can debate over the course of those next 2 to 3 years, but rising capex from the two memory giants in South Korea, from China, from the US associated with Terafab that Elon Musk is trying to build in Texas, that is very real. So if you look beyond memory and you look at production of semiconductor equipment, and then you look at the transition from silicon-based computing to photonics-based computing over the next couple of decades, there are opportunities all across Asia. And you might look at some of these charts and say, it's too late. Our view is looking forward. We look at prospective returns. To us, it's irrelevant what a stock has done. What we're trying to do is figure out what stocks will do over time.
Now, you've been talking about India. Some investors do point at the country's lack of large-scale AI. Do you agree with that assessment? And where do you think the next leg up for India's equity market's going to come from?
In the near term, the benchmark heavyweights on balance are weakened by AI's increasing adoption around the world. Largely, that takes the form of the Indian IT services companies. That has been the worst performer as a group year to date in India, and for good reason. It's been the same case over the past couple of years. But if you look beyond the hood, coming back to your earlier question, which was the right one on the energy transition and on power demand, how do you benefit from that? There are many companies in India that are enabling that. They're cooling companies that are benefiting from the data center build-outs. There are optical fiber companies that are on par with what we see in Japan and in China. The cable and wire companies, same thing. The transformer companies, the power transmission and distribution company. Just on transformers, these are very large pieces of equipment that take a very long time, months and months to build. The current order books are stretching from 2 to 4 years, 4 to 5 years, a multi-year demand for transformers. It's impossible to have the data center build-out that the world has planned for without more and more transformers. And many of those companies with genuine export opportunities are based in India. So you have that, but also more broadly, just about the Indian market. Yes, it has underperformed at the index level. What is very encouraging is over the last 4 months, we've seen very strong returns in the small and mid cap space. Money is coming back from that. Before that, the domestic bid for equities remains very strong. Monthly inflows remain very strong. My North Star in India, and this is what keeps us fully deployed in that market and keeps me coming back here to look for opportunities, is that you have a $4 trillion economy today. If the economy continues to grow at 7%, that implies that in 20 to 25 years, the size of the economy will double and double again. Typically, at that point, we would see an economy that is largely developed. Developed market equity valuations tend to be 1.5 to 2 times market cap to GDP. So if you grow it from where we are, 4 trillion to 16, and you take a 2 times multiple on that as an upside case, you're looking at a 30 trillion plus equity market. We're at 5 today. For the next 20, 25 years, it's plausible that we have an equity market that goes from 5 trillion to 25 to 30 trillion dollars. That's a lot of wealth that will be created. There will be a lot of opportunities that come from that. And the wealth that's created by those founders will find its way into new businesses. It'll find its way into new forms of consumption. And that's what keeps me coming back. It's going to be a fascinating ride to be a part of.
Vikas Pershad, Portfolio Manager for Asian Equities at M&G Investments. Thank you for that. That's it for this week's Market Focus Weekly. Check in at the end of every trading day for updates on the biggest moves and news in Market Focus Daily. If you have any questions or feedback, drop us a note at btpodcast@sph.com.sg. Till next Friday.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.